Good morning and welcome to Managerial Accounting. As always, we start with a look at our calendar to make sure everybody's on track with what's due when. So the Chapter 23 exercises should be submitted for grading by the end of the day today. We'll finish up the last few here in class today. And we talked quite a bit on Tuesday about the option of doing a early draft of your project. So if you want to do that, that's something you should be submitting by Tuesday. If it is not submitted by Tuesday, I will not be reviewing that for early comments and feedback. So anything that's submitted after Tuesday will be considered a submission for the final project, which is due on April 5th. Next week, we'll be covering Chapter 24. And so Chapter 23 problem due before midnight on Tuesday, and then Chapter 24 pre-quiz. I think at this point you all know the drill. So any questions about what's due, questions about the draft for the project or anything like that? Today, this morning, will be the last opportunity to tell me you'd like to be involved in the external team visit for the business program reviews tomorrow morning. So if you were thinking you wanted to do that, but just haven't let me know yet, please right now during class. Normally, I wouldn't tell you to do something else during class, but after class this morning, I will be putting together the final list of students and getting that Zoom link out to each of you so that you have what you need to be able to log in tomorrow morning. So what's that? I'm sorry. The business program reviews external team visit. I sent emails about it. So you should have, but we can talk after class. Okay, so that's where we stand. If there aren't any questions, anything about what we talked about on Tuesday. We started talking about standard costs, how they're developed, what they're used for, that those are the costs that move through our accounting records, and then we reconcile the variances at the end for a company that's using standard costing, which many manufacturers do. Any questions about what we discussed on Tuesday? So we had done exercises 1, 2, 3, and 5 together. And then I had asked you to try exercise 4 and 6 on your own. Those were review of what we had already done, just more practice. Does anyone have any questions on either of those exercises, 4 or 6? Okay. Then we will pick up right where we left off on Tuesday. Over here. And for class today, we will be talking about factory overhead variances. We will be looking at how to calculate them, looking at fixed and variable factory overhead separately. And at the end of our exercises, exercise 10, we'll be looking at how those standard costs get reported in our accounting records and how we make those adjustments at the end for the variances. So we know what factory overhead is. We've been talking about that term, factory or manufacturing overhead, since chapter 15, so very beginning of the semester. We know that factory overhead consists of variable and fixed costs. And as I already pointed out to you, those fixed costs look a little bit different in our analysis than the variable costs for overhead, as well as direct labor and direct materials, which of course are also variable costs. So as we look at the factory overhead variances, differences from what we planned or intended to spend or should have spent, and and then the actual spending, we will need to be able to separate out the part that is fixed and the part that is variable. So that's an assumption that underlies this analysis, is that we do know which costs are fixed and which costs are variable, because we assume that those variable costs are going to go up if we produce more and go down if we produce less. And we don't want to be identifying that variance as problematic. It's understood that will happen with a variable cost. So in order to do this analysis, again, we're going to separate the fixed and variable components, and we are going to use the same concept of the flexible budget in order to have our comparisons, to know what we should have been spending according to those standards. Why I can't get this to, there we go. And so I'm not going to spend much time on this this slide, because in a moment we are going to go to our first exercise where we are going to prepare our own factory overhead budget using the flexible budget formula, the flexible budget approach. And so it's going to look like what you see on your screen right now, essentially. So we're going to have varying levels of production, and we will separate out the fixed from the variable costs. And as you'll notice, as we learned when we went over flexible budgets in the last chapter, those fixed costs we will expect to be constant or the same across all of our relevant operating range, across all of our possible levels or expected levels of production. But the variable costs, we are going to we're going to calculate a per unit amount for those and apply that per unit amount to each one of the levels of production. All right, any questions at this point? Well, let's go to our first exercise then, which is exercise 7. And we will be putting together our own flexible overhead budget. Give you just a minute in case you are not there yet. So in the Cengage See Now exercises for chapter 23, we are going to start with exercise 7 today. Oh, by the way, I should have said this at the beginning of class. So as you know, I did not schedule one of the drop-in review sessions for this week because my Friday was completely booked, but I had asked earlier in the week, maybe even last week, if there's a time that works for you, if you want to be able to attend one, please let me know a day and time. I did not hear from anyone about wanting or needing to attend a drop-in review session this week. And so I do not have one scheduled. I will try again for next week. I will continue to offer them each week, and hopefully, you know, if you need that, you'll stop in. And if you want to be able to attend, but the times I'm choosing or days I'm choosing do not work for you, you just need to let me know. And we'll be as flexible as we can about that around your schedule and my schedule. So there will not be one for this week because nobody let me know a day or time that you would want to attend. And I'll look at my calendar for next week and get one scheduled. And I'll let you know that. I'll probably put it in the announcement after class today, just so people can plan. Okay, I assume everybody's here now. So let's look at the exercise 7. Now, if I didn't know Jay Leno, I would look at that and pronounce it Leno, but I'm going to pronounce it Leno. I have no idea. Leno Manufacturing Company prepared the following factory overhead cost budget for the press department for October of the current year, during which it expected to require 20,000 hours of productive capacity in the department. So as we look at the variable costs that are given here, these are based on an expectation of 20,000 hours of capacity. For the fixed overhead costs, we know that those should be the same regardless of whether we hit that 20,000 hours or don't. We are asked then to prepare a factory overhead cost budget for this department, for the press department, at these 3 levels of production. Just to reinforce the terminology that we typically use, I would refer to that as our relevant operating range from 18 to 22,000. And I tend to think of these as kind of best case, worst case, and likely scenario. So the 20,000 that's in the middle here, it doesn't have to be halfway between the two extremes, but the 20,000 is what we expected to happen, but we wanted to prepare a budget to say, well, what if we were lower or higher than that? For the fixed factory overhead, then that part's simple because it's going to be, by nature of being fixed cost, we expect them to be the same each time or each level of production. So we can just enter those same values. Supervisory salaries at 80,000. And if you're using an Excel spreadsheet, that's where that gets easy because you can just click and drag those across. 50,000 for depreciation and 32,000 for insurance and taxes. And the total was 162. So that's the easy part. The variable part just takes a little, it's not difficult, but it takes us a little bit more effort because we are given a total, assuming 20,000 hours of productive capacity. And so we know that's going to be the number that we enter here. So that column's actually a little bit less tricky. But because these are variable costs, we have to do some calculations to move our capacity from that 20,000 where we were given the totals. So this is how we need to do that. We need to take the totals that were provided to us and calculate a per unit cost. I'll do that right here. I'm trying to give myself enough room. So the $180,000 for indirect factory labor was for 20,000 hours. Whoops. And so if we take that total that was given to us for the 20,000 hours, divide by 20,000 hours, we find out the per unit cost or budget is $9 per hour. So if we only work 18,000 hours, how much would we expect to spend on indirect factory labor? 18,000 hours at $9 per hour is 162,000. And then we can repeat that calculation, $9 an hour for 22,000 hours, we would expect to spend 198,000. Make sense? So how do we do the power and light? What do we do with power and lights? We know that the total is 12,000. When we expect to work 20,000 hours, and so that budget is for 60 cents per hour. Go ahead and complete that line. And then try indirect materials on your own. And then you can put in your totals. And then the last step is we have our total variable and our total fixed, so we can sum those to get our total expected overhead budget for each one of those three levels of production. Questions, anybody? So we had already covered the concept of the flexible budget in the last chapter, the budgeting chapter. So this was not really anything new other than we're applying this to factory overhead. And as we move into our next topic, our next set of next couple exercises, we'll be using these results from our flexible budget to compare to our actual results and identify the variances in the variable and the fixed overhead categories. Whoops, clear my screen here. And then we can move ahead. Find my next slide. That is where I want to be. I think this is the slide I want. So once we know how much we should be spending on the fixed and the variable overhead, we can compare that to our actual costs, just as we did for direct materials and direct labor. And just as for those two components, for both the fixed and the variable overhead, there's going to be two pieces or two factors that go into determining whether we have a favorable or an unfavorable variance. We talked last class about who was responsible or who would we report variances to when we were talking about direct materials. So a spending variance would be reported to the supply chain or the purchasing department, and a usage variance, a quantity variance, would be reported to production. When we talk about direct labor, those standards come from human resources. So how much are we paying on average to our employees? Doing each one of those different tasks. And the usage, again, would be part of production, how many hours those individuals are working. As we look at our overhead variances, then we're also going to be looking at reporting those variances to the supervisors, the people who are in charge of determining that spending. Our next exercise will be exercise 8, and we'll be looking at our overhead variances. I said to you last class that all of the formulas, if you prefer to have the formula in front of you, all of the formulas do appear in the PowerPoint that you have access to on the textbook resources website. And they're also in our actual textbook. So in general, I prefer that you don't simply write down the formula and plug the numbers into the formula and see what works. I would prefer that you think about why is it that way? Why is it, why is that the variance? But you need to start someplace, and if that for you is having the formula in front of you and plugging in the numbers, that's a reasonable place to start. I'd prefer that you get past that to why is that the result? But I'm not going to go through all of the formulas for you. We're going to talk through these exercises and think about why, what is causing that variance from what we expected to spend. I did want to remind you the formulas are out here if that's where you want to start. Typically, I do provide formulas to you in Blackboard, but in this chapter, I have not done that because I've told you where they are, and I've also suggested I would prefer that that's not how you think about these variance calculations. So with that in mind, we're going to move on to our next exercise. Excuse me. And this is related, as I already mentioned, to calculating those variances for variable and for fixed overhead. Thomas Textiles Corporation began November with a budget for 60,000 hours of production in the weaving department. The department has a full capacity of 75,000 hours under normal business conditions. So remember, we've talked about the three different definitions or three different versions of the term capacity. Capacity could be theoretical, which is the perfect world scenario. We don't really use that in our calculations because we know that's unrealistic. It's never going to happen. So the other two that are relevant for us are practical capacity, which is, okay, we do live in a real world, and how much can we reasonably expect to produce if we are running at full capacity? But in a real world scenario where we have breaks, we do change shifts, we do take vacations, machines do need maintenance or repairs. And so that practical capacity is this number, the 75,000 hours. Our normal capacity would be how much we expect to use. So in this case, we budgeted for 60,000 hours. That would be our normal capacity. Okay, the budgeted overhead at the planned volumes at the beginning of November was as follows. So here's our variable and fixed overhead. Remember, we would expect the fixed overhead to remain constant regardless of our level of production, but the variable overhead is going to be based on the number of hours. In this case, they're using hours as their measure of capacity. The actual factory overhead was $725,000 for November. The actual fixed factory overhead was as budgeted. During November, the weaving department had standard hours at actual production volume of 64,500 hours. Determine the variable factory overhead controllable variance and the fixed factory overhead volume variance. Enter a favorable variance as a negative number using a minus sign and an unfavorable variance as a positive number. Round your interim calculations to the nearest cent if needed. So that's an important thing to keep in mind if we do need to round in order to make our numbers match theirs for the check my work purpose. We need to make sure that we are rounding as we go through the problem rather than waiting until the end. That's what it's telling us. Okay, so variable overhead, $450,000. Yeah, $450,000. Our actual expenditures. So I'm just going to put a little comparison here. Our actual expenditures, we were told that the fixed factory overhead was as budgeted. So they're telling us that was $262,500, what we had expected to spend. Just a tiny bit. And that the total was $725,000. So how much was our actual variable overhead? 462.5. Little crooked. Okay, so we now have our variable overhead calculated as well. We're asked to find the variable factory overhead controllable variance. So get my calculation up here. So they actually spent $462,500, and that was for actual production of 64,500 hours. And that means they spent $7.17 per hour. According to the budget, let me find some room down here. What they had budgeted was for $450,000 for 60,000 hours. So let's see how that compares. And so they had budgeted for $7.50 per hour. They actually spent $7.17 per hour. So what does that tell us about the variable overhead? Are we going to have a favorable or an unfavorable variance?
Unfavorable?
Well, if we budgeted for spending $750 and we only spent $717, are we going to be happy about that?
Yeah, I guess we would. So it's probably favorable.
Yeah, I think that it would be an accurate assumption. It would be a favorable variance because we are spending per hour. We know with variable, any variable cost, if we produce more, we're going to spend more. That's what variable means. And so the fact that we produced more than we had planned, we spent 64,500 hours when we had planned to spend only 60,000 hours. We already knew our spending would be higher than the 450,000 that we had budgeted. We would expect it to be. How much would we have spent? I'm going to take back up here. How much would we have spent if we, for the 64,500 actual hours, if we had spent the $7.50 per hour that we had budgeted for? How much would we have spent? $483,750 is how much we would have spent at the budgeted $7.50 per hour. We actually spent only $462.5. The difference between those then, what we would have spent according to the budget and what we actually spent is $21,250. Oh, and because it's a favorable variance, we already identified it as a favorable variance. We need to show that as a negative. Yes, we spent more than the budget showed, but we also worked more than the budget showed, and our per hour spending or per unit spending was actually less. And so that's why there's a favorable variance. That part makes sense? Let's look at the fixed factory overhead then. And as I told you last class, and I repeated at the beginning of class today, how we look at the fixed factory overhead is different than how we look at all three of the other product component costs: direct materials, direct labor, and variable overhead. Those are all looked at through the flexible budget lens, through the lens of spending per unit. And so all of our comparisons, all of our variance calculations are based on that flexible budget concept. Not true for fixed factory overhead, because it is not a variable cost. So what I'm going to do now with the fixed factory overhead is going to look and sound a little bit different. than what we've done with all three of the others. We are told that at full capacity, we can work 75,000 hours. And so for our fixed overhead, get my annotation back up here. For our fixed overhead, we could be spreading that $262,500 over 75,000 hours. Our full capacity, our practical capacity is 75,000 hours. And so if we had worked all of those hours that we could have worked, I'm not saying we should have worked 75,000. We keep coming back to that. Yeah, but is someone going to buy it if we produce it? It's not a good idea to produce it just because we can, just because it's within our capacity. But that's why what we're calculating here is called a volume variance. I should point out the other part of fixed factory overhead is a spending variance. So remember, we would expect the fixed dollar amount, the fixed overhead dollar amount right here. Oops, can't do that. There we go. This amount we would expect to be the same or constant regardless of our level of production. If we actually spent something different than that, the difference between what we budgeted and what we actually spent would be the spending variance. We don't have a spending variance here because we spent exactly, we're told, we spent exactly what we budgeted right here. Spending was exactly as budgeted. So had we used 75,000 hours of production, it's just hours of production. If we had used 75,000 hours of production, the cost would have been $3.50 per hour. So that's based on the maximum or the practical capacity. Because we produced fewer hours than that, actually 64,500 hours, our spending per hour went up, would go up to, just rounding off, $4.07 per hour. $4.07 per hour, rounded off. One way of looking at this is we wasted, by not using, we wasted 10,500 hours of our productive capacity. And so by not using our full productive capacity, we increased the total cost of our production. Those 10,500 hours that we did not use, everyone see where I'm getting the 10,500, the difference between what we could have worked, 75,000, and what we actually worked, 64,500. So the number of hours we did not use, those 10,500 hours at $3.50, increased our total cost by, I misspoke, increased our cost per unit in total. So our total, I need to be very careful how I say this. The total cost was exactly what we budgeted. The per unit cost went up, and that total impact is the $36,750. Whoops. $36,750 that had to be absorbed by the units we did produce. That $36,750 is the extra 57 cents per hour for all the hours that we worked. That extra cost had to be shifted from those units that hours that we didn't produce onto the hours that we did produce. The total cost, the spending was exactly what we planned. We were really good at that. But the fact that we did not work all of those hours means that $36,750 worth of overhead cost, fixed overhead cost, gets shifted onto the hours that we did work. And I think we can see that that's an unfavorable variance. Spending variance is 0. We did a great job of holding the line on the fixed costs. We spent exactly what we thought we would spend. It's an unfavorable variance based on the volume of our production. Does that make sense? And if you find this challenging to follow, that's okay. What you will want to do then is just go find in the PowerPoint or in the textbook, they're all right together in the textbook, and make a note of the formulas. This is the formula that we just used. Standard hours were 75,000 minus the standard hours for actual units produced, that was the 64,500, times the fixed factory overhead rate, which was the $3.50 that we just calculated here. So if you find that easier to navigate, I'm not telling you you can't do it that way. I just really hope that you spend some time thinking about, why is that the case? Why is it a problem, or why does it create this unfavorable variance? We spent exactly what we intended to spend. Why does it create an unfavorable variance? Well, because we have to spread those same costs over fewer units, and that makes the cost per unit, as I just showed you right here, higher. Any questions about that? So as I've been telling you, the way we look at the fixed overhead is different than the way we think about all 3 of the other sources of variance. Let's go on to our next exercise then. Just want to show you what we have down here first. So this is what our goal of this exercise is, to prepare a variance cost report. We're going to be looking line by line at our actual costs compared to what we should have spent based on the standards. Record whether it's a favorable or an unfavorable variance. So we're going to be using one of these cells. It can't be both a favorable and an unfavorable variance, so we're going to put it in one or the other. And then our totals down at the bottom. So let's look at what we're given here. Tannen Products Incorporated prepared the following factory overhead cost budget for the trim department for July of the current year, during which it expected to use 20,000 hours for production. And then we have a whole bunch of values in there. I'm not going to read through all of those. Tannen has available 25,000 hours of monthly productive capacity. During July, they actually used 22,000 hours. So we're now looking at 3 different quantities here. The budget was based on 20,000. The practical capacity is 25,000, and actual production was 22,000. So as we think about this, the variable overhead costs, we're going to be comparing. We need to find the per unit costs here for the variable overhead costs. These are for 20,000 units. And we're going to have to convert those, if you will, translate those into, yeah, but we work 22,000 hours. So we know those costs are going to go up. So we're going to have to recalculate those. The fixed factory overhead, this will be the budget because they're fixed quantities. But when we're looking at calculating our variance, that volume variance is going to be comparing 25,000 hours to what we actually produced, or what we actually used, 22,000 hours. Actual fixed costs were as budgeted. That's always helpful. So we know that any variance is going to be based on that 3,000 hour gap between what we used and what we could have used, just like we saw in the last exercise. Actual variable overhead for July was as follows. So I'm going to go ahead and pull those actual costs in now. just to save us some scrolling up and down. This is our actual cost column. We're going to have to calculate the budget based on the flexible budget concept. Our actual fixed overhead was as budgeted, so we'll pull those in, 54,500. $40,000. Insurance was 35,500. Okay, so all I've done is pull in the values for the actuals. They're just given to us here. So the actual variable costs are given here. And it tells us the fixed costs were as budgeted. So those are going to be right here. Whoops. Right there. So I just pulled those numbers in just to get us started on that first column. For our budgeted numbers, for the variable factory overhead, we're going to have to do some calculations based on what was given to us here in the original budget. So this original budget was based on 20,000 hours of use. So if we divide what's given by 20,000 hours, we'll get our per unit cost. So we expected to spend $2.30 per hour on indirect factory labor. We actually worked 22,000 hours. And so to get our flexible budget quantity, we need to take that $2.30, multiply by the actual hours worked, 22,000. And so indirect factory labor, we're going to be comparing our actual costs to the flexible budget quantity of $50,600. Everyone okay with where that number came from? Is that a favorable or an unfavorable variance? Did we spend more or less than we should have spent based on the budget? Our actual cost is less than the budget, right? And so that's a favorable variance. It is $900 less. And so we're going to enter $900 in the favorable variance. And remember, we are told to use a negative if the variance is favorable. We're leaving that unfavorable variance box blank, empty, because there was no unfavorable variance. It tells us if an amount box does not require an entry, we can leave it blank. Okay, everybody okay with that calculation? Let's go up to our power and light calculation then. That budget was based on 20,000 hours. And so that's a budget of 60 cents per hour. And we actually worked 22,000 hours. And so the flexible budget quantity would be 13,200. Again, our actual spending was less than we would have expected at 22,000 hours of production. That's a favorable variance of $200. Okay. Try the remaining one on your own, the indirect materials. Any questions at this point? If we had any spending variances for our fixed factory overhead, those would appear here. If we are spending on supervisory salaries, for example, this is not what we are told, I'm just saying this for example purposes only. If we actually had budgeted for something, something other than what we spent, if our spending did not match our budget in total for any one of these categories, that would be a spending variance. And it would show up here. Okay. Same way it did for the variable. There are no boxes over here because we were told that our spending exactly matched what we had anticipated spending in total. If I had been in charge of making these exercises, I probably would have included a spending variance here, just so you could see what that looks like. But you can imagine, use your imagination. I have no idea why that just yelled at me. Nothing but numbers allowed in that field. I'm not sure what it thought I was trying to put in there. So our total controllable variances, that is not based on volume. And so we're going to get to the volume variance right here in a moment, as we calculated in our previous exercise. But are there any questions about what we've done up to this point? Again, if there was a spending variance, if this actual cost, for example, was $60,000, if we maybe our supervisors got a raise or something and we had neglected to include that in our budget, we would have an unfavorable variance here of $5,500. If that was what we were told. The actual cost was different, but it wasn't. So I'm going to put that back. And so our total controllable variance, we have 2,000 unfavorable and 1,100 favorable. So the net, lumping those together, netting those together, is a $900 unfavorable controllable variance. Everybody good up to this point? Maybe? Was that a yes or a, I'm not sure? Yeah. Okay. The head tilt looked more like a maybe. Okay. The last thing we have to do mirrors what we did in the previous example, the previous exercise. They had 25,000 hours of monthly productive capacity. They only used 22,000 hours. Those 3,000 hours create an unfavorable volume variance. Because even though we spent exactly what we expected on our fixed factory overhead, that is the $130,000, we were spreading it over fewer units, which makes the cost per unit go up. So just as we did in the previous exercise, and I showed you the formula in the PowerPoint a moment ago, we're going to do that calculation. And I'm I'm just gonna sneak it in this spot right here since there's a nice white open spot. Total of $130,000 in fixed factory overhead in the budget. We could have been spreading that over 25,000 hours. And so the cost per hour for fixed factory overhead, if we used all of our productive capacity, would be $5.20 per hour. The fact that we left 3,000 hours on the table, we could have worked another 3,000 hours, means that we have a major, a $15,600 hit for our idle time. The volume variance. So the total factory overhead cost variance unfavorable, because the 900 is unfavorable and the 15,600 is unfavorable. We're going to add those together to get the total $16,500 unfavorable. So why do we call the top part of the report the controllable variance? And the bottom part, then, I guess by default, we would think of as being not in our control, an uncontrollable variance. The reason that we think of this as not being in our control is if we're using that concept of pull-through production that I keep talking about, we're producing because we have an order for it. Or maybe, I don't know, it doesn't say this, I'm just totally speculating. If we could have worked 25,000 hours, but we actually only worked 22,000, it does say under normal business conditions. Maybe there was something about the business conditions that were not normal. Maybe we had some machinery breakdown. It is July, and so maybe people were on vacation. Maybe the company has a shutdown during that. You know, there are a lot of companies that do a shutdown at the 4th of July, for example, for routine maintenance. So in any other month of the year, they would expect to work 25,000, but they didn't in July because there were holidays or a shutdown or machines out of order, or, you know, fill in the blank. I don't know exactly what happened. But we think of that as being not in our control to the same extent that the other costs are in our control, because it's based on volume. And I keep telling you, it's not appropriate to produce something just because we can. Just because we have the capacity doesn't mean we should produce if we don't have a customer, or we don't think we can sell it. We've seen in the absorption versus variable costing chapter that producing for inventory helps us to hide some of that fixed overhead. This company could have, possibly, could have worked the full 25,000 hours, and this fixed factory overhead then wouldn't have shown up as a volume variance. Instead, where would it be? On the balance sheet as inventory. It doesn't mean it's a good idea. Get some green check marks in there. Make sure I didn't have any math errors. That can happen. Any questions about calculating the overhead variances, fixed and variable, about reporting them, what we do with them, anything like that? What is that? I didn't see anything move. There's a strange noise in the classroom. Did it sound like it was outside?
I mean, it's kind of windy outside, but it sounded like it was these blinds in here.
Yeah, and usually that does happen, and usually I would see the blinds, you know, swaying, and I didn't see anything, although I can't see that window. I guess maybe it could have been that window. Yeah, because we're on the corner, the front corner that does get the wind there. I'm pretty sure the building's not crumbling or anything like that, so I'll just try to ignore it. Any questions before we move on to our final concept for this chapter? So let's move ahead then to exercise 10. And I've already explained, we talked about on Tuesday, that many manufacturing, maybe even, it might even be fair to say most manufacturing companies use the concept of standard costing because it does make their accounting entries more efficient. And it also allows them to more readily identify, because they need to identify those variances. Because at the end of the process, the end of the period, the end of the month, or when they finish the product that they're working on, they are required to do an analysis to see, okay, now how close were we? So, and then make those adjusting entries. So what we're going to be doing in this exercise is looking at what it would look like in our accounting records when we use standard costing. That we are not recording everything based on, in our records based on the actual costs, but instead we're using those budget or standard costs as we use our materials, as we incur the cost for both direct materials and direct labor. This exercise happens to be about direct materials. I'm not Italian. I have no idea how to pronounce that name. Cioffi. Manufacturing company incorporates standards in its accounts and identifies variances at the time the manufacturing costs are incurred. Journalize the entries to record the following transactions. First thing that happened, we bought 2,450 units of copper tubing on account at $52 per unit. The standard price is $48.50 per unit. So we planned to spend $48.50. That's what's in our budget, but if you know anything about what's happening in the world right now, you will find it no surprise that a raw material such as copper tubing would be not available at the price we had anticipated spending when we put our budgets together maybe last year. If an amount box does not require an entry, leave it blank. Okay, so in our material, we bought them on account. So I'm just thinking about which accounts are going to be affected by this transaction. We bought this product on account. And so we know we're going to have a liability, accounts payable, we have to pay for it. I'm pretty sure our suppliers are going to expect us to pay the $52 that's on the invoice, not the $48.50 that we had expected to spend. So that part is pretty standard. We've known how to do that since chapter 2. We have an invoice from our supplier. We bought these on account. 2,450 units at $52 per unit is $127,400. That's our liability to pay our supplier. But in our accounting records, we want to record this product at the standard. That's the concept of standard costing. In our materials inventory, and we already know that when we buy new raw materials, we're going to add them to the materials inventory account. But in that materials inventory account, we're going to record them at the standard. 2,450 units at $48.50 is $118,825. I'm going to put that on the screen where these numbers are coming from in case you didn't catch that. So $48.50 per unit, that's the standard times the actual units. So that's what we're going to report in our materials account, the standard price. But how much we actually owe our supplier is going to be based on actual cost for those 2,450 units. Again, we've known since chapter 2 that this cannot possibly be what our entry looks like because our debits and credits are not equal, and that's not acceptable. So the difference between those is going to be our variance. I need a debit of $8,575 to make this thing balance. And we can't ever have a journal entry that does not have equal dollars debited and credited. So what are we going to call that? That is a direct materials price variance. It's based on the fact that we had to pay an extra $3.50 per unit for each of those 2,450 units that we bought. I'm going to get those drawings off the screen since I did not accommodate the stretching. Okay, so we've already recorded the price variance at the time that those materials were purchased. Now, as we start using the materials in part B, we'll see how we move those costs through the rest of our accounting records. Any questions about what we recorded there in part A, the price variance? So we have 2,450 units of copper tubing at a minimum in our materials account, and in letter B it says we used 1,900 units of that copper tubing to make 200 air conditioners. 10 units of copper tubing are required at standard to produce 1 air conditioner. So how much material did we expect to use? If we made 200 air conditioners and we expect each of them to use 10 tubes, and we expect, based on the standard, so the 10 units is the standard quantity and the $48.50 is the standard price. That is $97,000 worth of materials that we would expect to have used. Is everyone okay with where that came from? Actual quantity of air conditioners. Standard is 10 units of copper tubing per air conditioner, and the standard price is $48.50. So in our accounting records, we would have moved, whoops, extra zero there, we would have moved $97,000 into work in process. If you go back to that flow chart in chapter 16 in the reference materials, reminder, when we move product, direct materials, out of materials, it moves into work in process as we start working on them. But we actually only used 1,900 units of copper tubing. We thought we would use 2,000. We actually only used 1,900. And so out of the materials inventory, we moved 1,900 copper tubes out of our materials inventory at $48.50 is how much. Remember when we put them into our materials inventory here in letter A, we recorded them at the standard price of $48.50. And so now when we move them out of materials into work in process, we're only moving actually 1,900 units at $48.50 or $92,150. In work in process, we recorded the amount we expected to use based on the standard, but we only move out of the materials inventory what we actually used. Again, we've known since chapter 2, we can't have this journal entry be done because it does not balance, because our debits and credits are not equal. And so we need $4,850 on the credit side to make this balance. What is that $4,850? It's the 100 copper tubes that we didn't use, compared to the standard. It's the 100 copper tubes that we did not use at $48.50 each. That is a favorable quantity variance. So up here in letter A, I can label this for us. Up here in letter A, this is an unfavorable price variance. And here in letter B, oops, put that over here. This is a favorable variance. The fact that an unfavorable variance is a debit and a favorable variance is a credit kind of makes sense if you think about it. A debit would indicate more expense, and a credit would indicate less expense, right? So a favorable variance is a credit in our accounting system, and an unfavorable variance is a debit.
So the reason we're using the 48.50 is because that's basically what we put in the budget for the price for all of this.
Yeah, you could think of it like that. But I don't know if you guys can hear, but the question in the classroom is, so we're using the 48, are we using the 48.50 because that's what's in the budget? We're using the 48.50 because that's what the standard is, and yes, it's related to the budgeting process. So that we don't have to be, think back to chapter 6. I know it's been a while, but in the inventory chapter, when we talked about LIFO, FIFO, average costs, all of that, if we didn't have a standard to use, we would have to, each time we use materials, we'd have to go back to say, okay, you know, what were those? How much were they? Which ones did we use? And it just makes our whole system simpler, cleaner. We know the price that's moving through the accounts is based on those standards. And also, as you can see here, we have upfront identified, we already know what the variances are. And now we don't have to worry about those anymore. So at the end of the day, when the product is done, we have in our records the standard price, and then we're comparing it to the actual prices, the actual costs. Does that answer your question?
I think so.
So it's not so much that it's in the budget, although in a perfect world, yes, what's in the budget would always match up with the standards. But especially when we're in a situation like we are now, the prices are so volatile, they're changing every day. You know, we're not going back and changing probably not going back and changing our budget for this year. But we could update our standards. We could partway through the year. It's not necessarily the budget, it's more the standards, which we hope line up with the budget. Well, guess what? That is the end of chapter 23. We have no more to do, and so there's no reason for us to start chapter 24 early. We're right on track with where we need to be. And so unless someone has something else you want to talk about, we will just call it a day for today. Anything else you want to talk about, go over, anything? All right, I will stop recording then.